is Riga in Latvia, the 18th and newest member of the Eurozone, and Real Economy is here to see how the single currency serves 333 million Europeans and why countries like this are still keen to join the Euro club despite the crisis of the past couple of years. On the show, we speak to Latvia's former Prime Minister and architect of the Euro adoption, Valdis Dombrovskis, and see how businesses and consumers view the transition. We'll also take a look at the convergence criteria. That's when we take a look back in time at Estonia's adoption of the Euro. Sub-zero temperatures make for a hardy people who've been through a financial crisis made that much harder because of years of a currency peg to the euro. Convergence criteria to join the Euro club also made austerity extremely hard. So, what exactly is a currency peg? Here's our crash course.
When countries exchange goods or services, they need to take into account two main things. Firstly, the exchange rate between their currency and that of the country they're doing business with. The rate fluctuates depending on supply and demand for currency. And secondly, any costs linked to the transaction. As the countries within the European Union do business with each other twice as much as they do with other countries in the world, some have eliminated the exchange rate problem by adopting a single currency known as the euro. Countries outside the Eurozone, such as Lithuania, are still subject to the costs linked to exchanging currency, but they are able to limit the fluctuations in exchange rates. To do this, they establish a fixed exchange rate between their currency and the euro, known as the European Exchange Rate Mechanism, or ERM2. Other countries, such as those in the duty-free zones in Africa and the Pacific, have also adopted this fixed rate system with the euro. The ERM2 sets an ideal attainable rate with leeway for fluctuation generally plus or minus 15%. However, when supply and demand for currency is too great, the rate risks going beyond the limits fixed by the ERM2. To avoid this situation, the central banks in each country intervene by buying or selling currency before adjusting the rate.
For Latvia, after its crisis, it made sense to move from a fixed currency peg and into the euro. And since the adoption on January 1st, 9 out of 10 Latvians pay in cash in euros in shops, while 3 out of 4 only carry euros in their wallets. But necessity aside, what does the transition really mean for businesses and consumers in the long run? Gianni Maggi finds out.
Sakret is a typical Latvian industrial enterprise that is part of a multinational group active in the building materials sector. Founded 11 years ago, Sakret has factories throughout Europe and a turnover of around 17 million euros with 100 employees. The company's director discusses the benefits of Latvia joining the Eurozone.
We have a lot of risks every day in our business. It doesn't matter you sell something, you buy something, or you produce something. And also, if you have the same currency in that country, what is your target country, and it's the same currency when you're living, then you can always understandable that one of the risks of currency exchange you can take away.
Latvia has suffered the consequences of the crisis, but it is recovering more rapidly than other European countries. The gross domestic product is higher than average. The unemployment rate, which had reached alarming levels, fell by about 5 points in 1 year, confirming the viability of this economy.
Latvian people vividly remember the onset of the crisis. So, are business owners worried about a second Eurozone crisis?
Everyone understands that now the credits will be cheaper, the loans will be cheaper. This is a move which definitely is in the direction to stabilize our economy. We are now the members of quite a strong club in Europe. If we, in that point when the crisis started in Latvia, we were already in Eurozone, I think that the crisis was not so hard as it was without euro.
When euro coins and notes were first introduced in 2002, prices in some countries skyrocketed. But what's the situation in Latvia? We put the question to a consumer association representative.
On the one hand, we have these official statistics, which says that basically we have the decrease of prices overall. On the other hand, of course, people sometimes, from time to time, tell us that prices actually went up. What we notice in the course of our work, that actually prices both go up and go down. I think it's more or less even, I would say so.
When the euro was introduced in 1999, it became the official currency for 11 countries. Over the years, 6 others, including Malta, Cyprus and Estonia, followed, with Latvia being the 18th and latest entrant. I sat down with the country's longest-serving and former Prime Minister, also the architect of the euro convergence, Valdis Dombrovskis, and began by asking him all the pain that Latvia had undertaken. Had it been sustainable, or could we see the country in crisis again?
One of the tasks dealing with a financial and economical crisis we were facing back in 2008-2009 was to ensure that recovery we are facing is sustainable, and so that we are not building another bubble. Recovery was much more based on industrial production, especially export-oriented industrial production, and not on real estate speculations than it was before the crisis.
When you look at all the criteria to enter the Euro club, are they strong enough to get in? And what about getting out?
Definitely they are strict enough, and as we see, it's not so easy for countries to meet Maastricht criteria. I think what was wrong really with Eurozone that almost for a decade it was free not to follow Maastricht criteria. Of course, currently we know that there is no clear exit from the Eurozone, and practically I believe it would have been a very complicated decision for any country.
When you look at the things you had to do for convergence, did more have to be done?
I believe we had done a huge amount of adjustment. All in all, we had done 17% of GDP fiscal adjustment. Roughly 1/3 of this coming from tax raises and 2/3 from expenditure cuts. And now our budget deficit, for example, for this year is below 1% of GDP.
Another question that's been raised about Latvia joining the euro is the potential risk of it becoming another Cyprus.
Well, this is a huge misconception. In Cyprus, banking sector assets vis-à-vis GDP were close to 800%. EU average is somewhere 360, 370%. In Latvia, it's around 130%. So we have small and well-capitalized banking sector to compare with some countries which went into trouble.
Public support for the euro adoption in Latvia wasn't very strong. Not everyone was buying the story that a single currency for a single market would lead to low inflation and better public finance. Now, Estonia, which adopted the euro in 2011, also did it without much public support. But 3 years later, as Sebastian Lebelzik reports, the picture is quite a different one.
3 years ago, Estonia adopted the single currency with a certain amount of hesitation. The Eurozone was in crisis and its countries were going through painful reforms in response to the Maastricht Treaty on European Union.
I'd say the euro had the biggest impact here during the crisis, when people were okay about the big reforms we were putting into motion. They saw the euro as a symbol, an objective to achieve. It was easy for them to come to terms with its relevance.
In the midst of this, in 2011, Estonia saw its GDP rise 9.6%. This was due first and foremost to a sharp increase in exports to other EU countries.
Behind me are Finland and Europe, in front of me Russia. 3 years after adopting the euro, more than 80% of the Estonian economy is concentrated on Europe, with more than 40% towards the Eurozone alone.
And the arrival in the Eurozone of its neighbour Latvia will surely make the European footprint even bigger.
Latvia is one of our biggest trading partners, and Estonia has been its biggest external investor for a long time. So having the same currency makes our relationship even simpler and much stronger.
90% of Estonia's economy is linked to exports. a market that has doubled since 2005, reinforcing the euro's positive image.
6
months after Estonia adopted the euro, we asked companies in the country for their thoughts. 2/3 of them replied that the move was a positive one.
I believe that the euro has provided good value for most Estonians. It's especially good for those who travel a lot and work in the export trade, as it eliminates the problems associated with exchange rates.
Already, the Estonian kroon is no more than a distant memory for this strong force in the Eurozone, and growth projections are looking good, especially since Estonia hopes to become the industrial hub of the Baltic. Average prices there are 37% lower than in neighbouring Finland.
Still with us is Latvia's longest-serving and former Prime Minister. Mr. Dombrovskis, if you take a look at public support, you didn't seek it.
What we had seen is that during the last year, public support for joining Eurozone has increased substantially. We do around 70% of our foreign trade in euros, which means that we were wasting lots of money just converting currencies back and forth from Lats to euros. This cost is removed from economy. Second, we expect this to lower interest rates. And third, we also expect this helping with attracting foreign direct investment.
If I had to ask you one thing that you would wish for Latvia and the euro in the future, what would that be?
It would be sustainable development without any major crisis and major problems as we were facing a couple of years ago.
Well, that's a wrap from Latvia and its parliament. Join us next time to delve into the psyche of the international investor and their relationship with Europe. Until then, thanks for watching. See you next time.